What is USDA's Livestock Risk Protection Program, often called LRP? In this short video, I'll provide the basics of what it is, a little bit about how it works, and I'm going to conclude by talking about the numbers. In other words, why it's worth your time and why it can benefit your bottom line. So what is LRP? Well, LRP is an insurance product for cattle and swine producers that protects against unexpected market declines. So if you take a step back and you think about insurance you already have, perhaps on your livestock operation, your house, your ranch, your car. Let's look at the car. You have insurance on your car to protect you against unexpected things happening, basically a crash. Well, LRP is similar. It's insurance against unexpected things happening, in this case, the market declining. So it's meant to protect your bottom line. Many of you might already be aware of USDA's insurance products they have for crops. These have been around for many years, extremely popular at least in the past 20 to 30 years. And crop insurance does the same thing, only it protects against natural disasters as well. So basically it's a USDA backed insurance product for livestock producers that's going to protect them when the prices go down. So who qualifies for LRP? Basically, you have to be an owner of livestock. You have to own cattle, really any step along the way, or you have to own swine. Those are the individuals who would qualify to utilize LRP. So I've mentioned that LRP protects against unexpected price declines. Well, what is an unexpected price decline? What if the market's already bad? Is there anything I can do in those circumstances? Sometimes when you're walking around, you've probably pulled your iPhone out or you've got on your computer and you've looked at the futures market. If you're a swine producer, you've looked at the lean hog futures. If you're a cow-calf, you've probably looked at the feeder cattle futures. If you're feeding them out and finishing cattle, you've probably looked at the live cattle futures. What you're looking at when you open those websites is what the market is expected to be 6 months, 7 months, a year down the road. LRP functions the same way. It's going to protect you when the market falls below what it is expected to be. So basically what LRP will do is, with a few adjustments here and there, LRP actually uses the prices from the futures contracts. If it's a heavy cattle, it'll be from the live futures contract. If it's swine, it'll be from the lean hog. If it's a feeder cattle or something even 600, 500 pounds, up to 900, you're going to be looking at the feeder cattle futures price. And so what LRP covers is those unanticipated declines. Let's go through an example to help illustrate this. If we're sitting today and the cash price for feeder cattle is around 150, we look ahead 6 months on the feeder cattle futures and it's going to be 140. That's what the market projects. LRP doesn't cover that drop in price because it's anticipated to drop from 150 to 140. What LRP covers is a scenario like this. If we look out 6 months and the feeder cattle futures price is around 160, well, let's fast forward. It turns out that instead of being 160, it actually ended up being 140. That's an example of an unanticipated price decline, and that is a scenario that LRP protects against. So LRP allows us to look out in the futures price and to utilize a simple and affordable tool kind of put a floor beneath the price that the market is anticipating. So what LRP does is it allows a producer to look in the future and anticipate when you're going to start marketing livestock. Let's do an example. Maybe it's April 1st today, and you typically market some livestock around September 1st. What LRP allows us to do is to lock in a floor price for September 1st based upon what the market anticipates the price being. And to do that, LRP requires that you pay a premium. And we're going to talk more about that at the end as to why LRP is a good deal. But basically the trade-off is this. We use LRP to put a floor price beneath our livestock, and if the price falls, we're going to get paid the difference. And just like any insurance policy, to acquire LRP, we are going to commit to pay the premium after the policy is over. So let's do some examples to help illustrate how LRP works. LRP is offered just about on a monthly basis. So at any point in time, we can sit down and we can look at LRP contracts, and starting about 3 months out, going to a year out, about every month there will be a contract that we could purchase to lock in a price with LRP. So let's just hypothetically again use September. It's April and we want to lock in a price. We look out and the price of feeder cattle is $150. LRP allows us to insure between 170% of that expected price. LRP calls that anticipated price the expected ending value. So if we insured 99% of that expected ending value of $150, we're basically insuring $148.50 because $148.50 is 99% of $150. That's called a coverage price under LRP terms because that's what you're covered. If the price falls below that, you're going to receive a payment for the difference. So if we do that, we fast forward till September, and in September we want to know what the actual market price is. Now, a key point with LRP is we're using national prices when we when we start with LRP, and when we determine if a payment is due, we're also going to use more of a national price. We're not going to use the price that you receive from your livestock. Now, obviously, there's a correlation, and hopefully a very strong correlation, between what the national market is doing and what you're receiving from your livestock. But it's very important up front to realize that you have to own the livestock, but what you sell them for doesn't matter for LRP purposes. So if we get to September and the $148.50 coverage price that we set, if the national market at that point in time is $155 or anything above $148.50, we're not going to receive an LRP payment. The market didn't fall. Now, if it's anything below that, let's say it's $140, we're going to receive a payment that would be the difference between $148.50 and $140. LRP functions on a hundredweight basis. So we would calculate if we insured a 500-pound calf, let's say 500-pound steer, we would get $8.50 for each hundredweight. So you can multiply that by 550. You can figure out what the LRP payment would be. So LRP is a fairly straightforward tool. One of the nice things about LRP is there's no surprises. Other risk management tools, futures and options, they have advantages. But if the market moves against you, especially if you have a futures contract, you might be stuck with margin calls. If you're in the cash market, you don't do anything, well, it's nice because you don't have to pay a premium for any insurance. The downside is if the market goes against you, you're going to be stuck with a pretty good loss. So LRP has the advantage of knowing up front exactly what it's going to cost you, and then if the market moves downward, you have protection. If it moves upwards, you're going to be able to take advantage of the market with no margin calls, etc. So why is LRP affordable? Probably 30 years ago, USDA began to get serious about having insurance products that work for livestock producers and farmers, mostly crop producers at that point in time. And what Congress did is Congress continually told USDA to improve the product and to make it more affordable. The problem with the early versions of crop insurance is that farmers, ranchers, they're kind of next year's people. They always are optimistic that next year is going to be better. Next year we'll have the rain. Next year the prices will be higher. The only problem with an optimistic attitude, it's the same attitude that keeps them farming every year, but it also means that nobody wants to purchase insurance because they're always optimistic that next year will be better than this year. Faced with that, Congress decided to make the insurance products extremely affordable. And the way they do that is USDA essentially only requires a producer to pay a certain amount of the real premium. So it's like signing up for your car insurance. You get a bill for $1,000 and then they say, well, we're only going to make you pay a part of that. That's essentially how USDA's insurance products work. So the thought being this, it's a whole lot more affordable at the end of the day to have an insurance product where farmers are paying part of the money in than to have a costly, what they call ad hoc, unplanned bill past Congress that can cost billions of dollars. It also benefits the taxpayers because we have a stronger agriculture sector when you have a good crop insurance program and livestock insurance program, so you can make better planning decisions knowing that your bottom line is covered. So with livestock risk protection, the USDA will reduce the premium that you have to pay anywhere from 35 to 55%. In reality, to buy the coverage that is at the levels that most people will want, it's going to have a 35 or a 40% discount. To put that into numbers that are easy to understand, Let's say we had a feeder cattle. Let's say we had a steer we wanted to insure, just one. And let's say the insurance costs $20 a head. With the premium discount, it's going to cost closer to $13 a head. If you have a swine, maybe we're talking $6 a head. It normally costs maybe $6 a head, closer to $4 now once you add that premium discount. And that's why people are very interested in LRP, is because risk management just became a whole lot simpler than it used to be. Our next video, we're going to cover more of the nuts and bolts of LRP to help you understand kind of how it works when the market moves different directions, and put some real pen to paper and do some examples. If you like this video, be sure to subscribe to my channel now. If you have any questions, we want to be able to address the questions that you have. Please put them in the comments section so that our next videos can address those and help you understand LRP as good as possible. Additional videos that we will put out will include some really interesting analysis that demonstrates how LRP would have done historically, and some tips and tricks of how to maximize its potential for your operation. Appreciate you taking time to listen to this video.